Should you invest your money to finish paying off your mortgage faster, or is it a better option to invest in the stock market to make it grow as much as possible in the long term? Today, I'll do the math and I'll find the answer to this popular question. Indeed, it is a question that many homeowners grapple with, and the answer isn't always straightforward. So let's break down the pros and the cons of each option to help you to make an informed decision at the end of the video. But first, it is important to understand the basics. Paying off your mortgage early means that you are putting up and making some extra payments every single month towards your principal loan amount, and this results that you'll pay less interest in the long run. On the other hand, by investing, you decide to invest in great financial products such as stocks, bonds, and ETFs with the objective to outperform the performance that you'll be able to achieve by paying off your mortgage early. At least that's what you should be aiming for. But the first thing that you must do to determine what is the best option for you is to first determine what are the two more important inputs, which is what will be your interest rate and what will be the performance of the overall stock market. In terms of your average interest rate on your mortgage, you can take in consideration that over the last 30 years, the average interest rate has been around 4 to 5%. So for the case of this video, we'll be using a 4% interest rate on a period of 30 years. We can see that historically, the S&P 500 has been able to achieve a performance of about 10% per year. In our evaluation case, we'll have a $300,000 mortgage with an average interest rate of about 4% on the next 30 years, and we'll take in consideration that the first payment will be made on the 1st of January 2024, and it's going to be made on the 1st of every single month for the next 30 years. This would make that your monthly scheduled payment would be about $1,432.25. In practice, you'd even have more options to pay off your mortgage, for example, bi-weekly or weekly, or even to pay it faster with different double payments. But in the case of the video, we'll keep it as easy as possible to make it easier for you to understand the whole principle behind it. As you can see, by paying your mortgage regularly with only the scheduled payment, you would have paid over $215,000 in interest payments at the end of the 30 years period. But in the case that you want to pay back your mortgage faster and that you'll be making some additional $400 payments every single month, well, you can see that your total interest payment would drop to about $134,000. This would have helped you to save over $81,000 in interest payments, and this would have shortened your total loan period by about 121 months, or about slightly over 10 years. On the other hand, if you'd only pay your scheduled payment of $1,432 and that you'd be investing the other $400 in the stock market with an average annual return of about 10%, well, in 30 years, you'd have over $631,000 in your portfolio. So in that case, it would be a no-brainer to invest in the stock market, but we forget an important criteria. In fact, as I just mentioned, by paying off your mortgage faster by making some extra payments of $400 per month, it actually helps you to save slightly over 10 years on your total mortgage period. So during this 10 years period, if you decide to invest this $400 additional payments add with your initial payments on your mortgage of $1,432, it makes that you'd be able to invest at least $1,832 per month in the stock market for 10 years. And so with the same average annual return of about 10%, this would give you about $366,000 in your portfolio. It means that with this option, the total gain that you would have made would have been of about $447,000 after 30 years. Obviously, in my calculation, I haven't included any insurance or tax fees that you'll have to pay in both cases. So theoretically, with a fixed interest rate to 4% and with an average annual return of about 10% for the overall market, we find that the best option would be in that case to invest in the stock market in the long term. But as we'll see later on in the video, the current interest rate for many mortgages are quite higher than 4% at the moment, which can imply obviously and can can directly impact your decision. However, in practice, the situation can be quite different. Even with all the best optimization to try to reach the best potential of return on the long term, to have no one to whom you owe money and to have no monthly payments give you more freedom with the money that you have. Life is full of unexpected situations such as layoffs and health issues, and so it isn't a bad thing to try to limit your financial stress by paying off all your debt. This is obviously a peace of mind that you wouldn't have if you would have to pay your mortgage every single month and if it would depend obviously on the hikes of the interest rate. In fact, even if we've used a scenario where the interest rates were quite lower with a 4% compared to what they currently are with about 6% at least on average on every new mortgage, well, you can understand that this represents a way bigger amount of interest payments that you would have to pay every single month on your overall mortgage, and which would make that maybe the investing option wouldn't be the best for you. In fact, when you think about it, to pay off a mortgage with a 6% interest rate, it is pretty much the same as investing in the stock market with a certain average annual return of about 6%. In my personal case, since my interest rate is slightly over 6% at the moment, it is why I'm trying to pay off the debt as fast as possible, because this will help me potentially in 2026 or 2027 to buy another bigger properties with all the equity that I'll have accumulate on this property. Keep in mind that even if you decide to tackle your debt and pay it off as fast as possible on your current mortgage because the interest rates are quite high right now, well, you'll still be able later on to refinance it if the interest rates are quite lower, which will give you a better option on the long term. Add to this, in 2023, we've seen that it has been a crazy year in the stock market where it has returned over 20% only during that year. And so it means that in 2024, there are many analysts that predict a slowdown in the growth of many companies and of the global economy. And so it could be another great reason for you to pay back your mortgage faster during this year. However, keep in mind that you should always diversify your portfolio and always have some money for some potential emergencies in case that anything goes wrong. So make sure that you don't use all of your investing assets to pay the debt that you currently have. But in that case, what are the big pros of investing your money instead of paying your house faster? First, there is obviously the case where the interest rate will be super low, for example, between 1 to 2%. Well, this would make that your monthly mortgage payments would be quite lower because you wouldn't have to pay all the interest payments that you have with a higher interest rate. Also, if you plan to change home in the next 3 to 5 years because, for example, your job needs you to be on the road, well, in that case, it might not be the smartest decision to pay all of your house right now because you never know what could happen with the real estate market on the short term. And I would say that the last reason why some investors wouldn't want to pay their property faster is in the case that these properties are generating some business income. For example, if you have different rental properties that gives you some rent income every single month, well, all of the interest payments that you'll have to pay on your different mortgage will be all deductible on this income. So it can obviously help you to save more money to potentially also buy more properties in the near future. The only problem that I have by contracting too much debt, however, is that you are way too dependent on some potential fluctuation of the interest rates. And it is one of the reasons why so many companies have faced many difficulties between 2022 and 2023 because of the massive hikes that we've seen. In my personal opinion, the only valid reason for you not to pay your mortgage faster is if you currently have a super low interest rate. But in my case, as I mentioned earlier, since I have an interest rate that is slightly over 6%, it makes obviously that I want to tackle these big liabilities as fast as I can to potentially refinance my property in the future, especially since at the moment I have great tenants that are paying their rent on time. It obviously helps me to pay a certain portion of my mortgage, my insurance, and my different taxes on my property. And it makes that even when I'll move in and that I lost one tenant, which makes that I'll have only 2 tenants, it will still help me to pay a lot of my different expenses linked to this property. So at the end of the day, it gives me more freedom with the money that I earn from my different jobs and side hustle to potentially reinvest in my property and in different other ETFs and stocks on the stock market. And so it is why I would say that for any investor that is looking looking to invest in real estate, it can be to buy their first house or even to buy different rental properties. It is also to find the balance between investing in the real estate market, but also to keep some liquidity and to also invest in the different investment vehicles on the stock market. But on your side, if you want to find my story on how I've been able to purchase my first rental property at age 24, well, check out the video that's gonna be right over here, and I will see you soon. Peace!